welcome to Global Mantra Market Outlook 2015, a special series that we bring to you from the City of London, talking to a lot of prominent fund managers and market speakers about their outlook into the new year. Joining me on the show today is Dominic Rossi, Global CIO-Equities at Fidelity Worldwide Investments. Dominic, it's great to have you on the show. Thanks very much for taking out the time. How are you looking at 2015, especially the U.S. markets? Because in one of your recent comments, you said that the U.S. markets are perhaps likely to make fresh highs into the new year.
I think that's right. I think that the outlook for 2015 in the U.S. is pretty much the same view that we had at the beginning of 2014, that the U.S. market's going to continue to see earnings growth and dividend growth, and with a fairly accommodative monetary policy, and that's likely to take the equity market higher. So we're certainly talking about fresh highs in 2015, and I also think going into 2016 as well.
So do you think the U.S. right now is clearly in a secular bull run? Because a year back there was an opinion that, if you take the timeline from the bottom of the crisis for the U.S. markets, we are perhaps 5 years already into the bull run. Do you think that this rally is likely to continue, or do you think there would be cyclical moves coming into the cycle?
I think the bull market is going to continue. I think the one disruption that may take place will be the presidential election of 2016, which may sound like some time away, 2 years, but still I think that's the next sort of milestone that the US equity market will have to navigate. I think my sense at the moment is that the recent volatility that we had in the US equity market really meant that we were entering the second half of this bull market, but no more than that. In the second half, what usually happens is interest rates begin to tick up. I think that will happen next year. I think volatility, which has been low, has basically bottomed for this cycle, and that too will begin to trend higher. But I still think we can expect higher earnings, higher dividends and higher valuations over the course of the next couple of years.
There's not concern on valuations right now?
No, I really don't think that there is. There certainly some commentators take the view that the S&P earnings are inflated, they're at all-time highs, and if you cyclically adjust those earnings, then the US stock market looks very, very high indeed. I don't think there's any prospect for corporate operating margins to fall next year. In fact, I think margins are going to continue to trend higher. I think returns on equities is going to trend higher, and the reason for that is that labour costs in the US are low. Commodity prices are falling, and I think we're going to see further increases in the operating margin. As a result of that, earnings, I think on next year we're on 16 and a half times earnings. On 2016 we're probably at about 15. So I still think that both margins and earnings, and on top of that even multiples, can go higher. So I think before this next year, I think the market will get to between 2,200 and 2,300, and I'm even thinking that before this bull market is over we could get to 2,500 on the S&P 500.
Interesting. How do you react then to opinion where people talk about the fact that with the end of QE you perhaps are going to see the last leg of the bull run in the US markets?
I think certainly QE was an important support for equity markets whilst we were in a period of weak economic growth, but I think we're moving away from that phase. I think private sector GDP growth during this cycle has anyway been 3%. It's been the fiscal side which has acted as a drag, and I think now that the fiscal profile is becoming more balanced, that indeed we will see 3% GDP growth throughout 2015. So I don't think that we need the prop of QE that we've needed in the past.
What about the dollar rally? I mean, we've already seen a strong one this year, and there is expectation that it's only going to get stronger into the new year. Where will money find its way? Do you think it'll fuel equities further, or would money also move into treasuries?
I think there are 2 points there. The first is the dollar going to continue to strengthen? And I think it will. And
go to 95 perhaps?
Difficult to be too precise about levels because it so much depends on policy shifts. But I think that we will see the dollar strengthen because monetary policy is now in favour of the dollar, but more importantly, structurally the twin deficit, the fiscal deficit and the trade position have been improving for the last 3 years, and that's a fundamental change which supports the dollar. To your second point, there is a very clear correlation between a rising dollar and a rising multiple on the stock market. And I think that is something which we will see next year. So the S&P 500 isn't yet expensive, but I think it will become expensive before this bull market is over.
What happens if we see rate hikes midway through the year? Firstly, what is your expectation? When will rate hikes happen? How will it proceed? How will the Fed move with its monetary policy decision? And what will be the impact on the markets as also the economy?
I think the Fed's been smart. This time last year it was all about unemployment levels when Yellen took over.
Sure.
And she's quite cleverly navigated the market onto thinking about the dual mandate, unemployment and inflation.
Yeah.
The reason why that's important is because the inflation outlook looks very, very benign indeed, particularly with oil prices falling. That means that I think we'll see a more dovish Fed than many commentators think. I think we will see some interest rate hikes next year, but I think they'll be at the summer at the earliest, and maybe we'll only see 2, maybe 3/4 point moves, which actually, given the strength of the economy, is something which I think the equity market will be able to handle.
Then how do you react to the opinion there is on the market about perhaps 2015 not being a year when we see any rate hikes? It could be a 2016 story because the treasury markets are not reflecting any potential hikes as of now.
Yeah, I think the market's going to be pleasantly surprised, if I can put it like that, by the economic growth. I think we will see real increases in income growth, in wages. So that will be the pretext for early interest rate rises, but the inflation picture is always going to be a reason why the Fed, if it wishes to, can hold back. But we will get some rate rises next year.
So you believe rates will go up in the middle of next year. Okay, so what is, where does that leave your overall outlook as far as sectors are concerned in the U.S.? Because there's talk about how valuations in the tech sector are, somewhat similar to what happened in 2001. There are no direct comparisons, but people are drawing parallels to what's happening in the technology sector. What's your view there?
I still think valuations are a long way short of the kind of exuberance we saw back in 1999. Remember, in 1999, GE was selling at 40 times earnings. So we're a long way from that kind of situation. And indeed, my whole thesis about this equity market is that it's the inverse of the last bull market. So whereas the last bull market was all about re-rating of tangible assets, this bull market is all about the re-rating of intangible assets, human capital found in biotechnology and information technology. So that will continue. I think the key risk to the Indian market is domestic politics. I think Modi has come in with a very strong mandate. I think the international capital markets have supported Modi thus far, and the trouble with capital markets, they can lose patience, and certainly they can have less patience than politicians usually require to effect reform. And my concern for the Indian market next year isn't the international environment, it's that investors lose confidence or lose patience in the reform program.
So even if there's global volatility, but if the Indian government continues to deliver, you would continue to invest and perhaps increase allocations to the Indian market?
Correct. I really think it's about a domestic reform agenda.
And what about if rates go up midway through the year? You think that would cause volatility for India and other emerging markets?
I think it's a headwind. I don't think that emerging markets are as vulnerable to a dollar rally today as they were in the 1990s, simply because many of them have developed their own local sources of financing, particularly local currency debt markets.
What's a risk for the US? Because from whatever you're saying, it seems like there's a fairly strong optimistic scenario playing out for the economy, and it's the sweet spot, US being the sweet spot, will continue into 2015. What's the risk?
I think there will be, as I said, volatility will tend to rise in the second half of the bull market, and I think with the interest rate rises we will see more volatility, as we did just last month, and how quickly the market came back. That could be a more frequent characteristic of the market next year, but I think the real hurdle for the equity market is going to be the presidential elections in 2016.
What about deflation risks in Europe? You think that could impact the US, or would it be more centered around the Eurozone itself?
I mean, the US, in the end, is a domestic-driven market. And I don't think that will change. I think my fears about deflation in Europe are actually less today than they were 6 months ago. 6 months ago, frankly, I was tearing my hair out because the euro was so strong. The ECB was ignoring its own, was ignoring the inflation numbers and was believing in its own forecast, and it was allowing its balance sheet to shrink. All those things have now reversed, and we're seeing a weaker euro and a weaker oil price. I think, therefore, we're going to be pleasantly surprised by the progress of the European economy in the first quarter of next year. I don't think structurally we're out of the woods yet in terms of the European economy or equity market, but I think now that valuations have had a dose of reality in recent months, that actually January, February could be a better time for European equities.
So would you be buying Europe in 2015?
I think I would be buying it now because I think there's a decent trade. But I don't think yet we've seen the sustainable earnings growth that you need in an equity market to see a multi-year bull market. I think we're some distance from that yet.
Okay, let's talk about emerging markets then, and the fact that if QE does come about in Europe, we've already seen an additional stimulus from Japan. That money could find its way fueling emerging markets. Do you believe that theory?
No, I think emerging markets have got their structural problems in front of them, and they still have to face up to those structural problems. And I think growth for emerging markets is going to be a continued disappointment. I think Chinese growth is going to continue to disappoint, and I think generally, particularly amongst the commodity countries, I think we're going to see weakness as well. The real axis for investing in emerging markets today is no longer around growth. It's about reform, and those countries which are committed towards reform and deliver on reform, those emerging markets will continue to outperform those which don't. We've already begun to see that, and I think that's the real key for emerging markets over the next 2 or 3 years.
I'll come to that point in a bit. I just want to address, do you think emerging markets will continue to be a differentiated bunch as was the case in 2014? Or do you think there would be a unified trade given that the dollar is going to strengthen, so that's going to have its impact on EM currencies? Or do you think the weakness will be more felt in weaker spots like the Eurozone as well as Japan?
I think the strong dollar is a clear negative for commodity-based emerging markets, and that is Russia, that is Brazil, and that is South Africa. I think other emerging markets can escape that as long as the reform agenda, which we just touched upon, is pursued and vigorously.
The reason I ask you that is because sitting out in India, we expect global uncertainty to be a key risk for the Indian market. Do you agree with that view? Do you think that as long as countries like India, continue with the reforms process, the governments deliver on the promises they've laid out, that we would be insulated somewhat, given our domestic fundamentals, to what happens globally?
I think the key risk to the Indian market is domestic politics. I think Modi has come in with a very strong mandate. I think the international capital markets have supported Modi thus far, and the trouble with capital markets, they can lose patience, and certainly they can have less patience than politicians usually require to effect reform. And my concern for the Indian market next year isn't the international environment, it's that investors lose confidence or lose patience in the reform program.
So even if there's global volatility, but if the Indian government continues to deliver, you would continue to invest and perhaps increase allocations to the Indian market?
Correct. I really think it's about a domestic reform agenda.
And what about if rates go up midway through the year? You think that would cause volatility for India and other emerging markets?
I think it's a headwind. I don't think that emerging markets are as vulnerable to a dollar rally today as they were in the 1990s, simply because many of them have developed their own local sources of financing, particularly local currency debt markets, and many of them also have built strong dollar reserves in their central banks. But it's still a headwind. But if India, if it commits to reform and delivers on that reform, I'm sure the market can continue to progress. But that's a big if.
That's a big if. Why aren't you satisfied with what the government has done so far? Don't you think they'll hold out?
I think yes, but it's still early days yet, and I think we know that India, in terms of its political structure, is still a fairly federalized country, where the states have tremendous autonomy, and affecting real reform at that level is a tough ask.
But after this 30% rally that we've seen for the market, trading at 15, 16 times 1 year forward earnings, do you think that there's more headroom? Because at the peak of the crisis, India was at about 21, 22 times. Do you think there's more headroom for the Indian markets from here? And if there is, then are you going to be looking at consumers? Are you going to be looking at the export story in India or the infrastructure story to invest incrementally?
I do believe that there's room for the multiple to go higher if that reform, and if the government retains confidence. I think it's in the domestic story.
Okay, so consumers is what you're going to be continuing to
and
back.
maybe even the banks.
Financials. Okay, your top three emerging markets then for 2015, where you're definitely, given the reform push, you're going to be looking at increasing allocations.
Yeah, I think I think the danger in emerging markets is to buy the value traps.
Okay.
Because that's where there is no reform agenda. So that's Russia, that's Brazil. I'm not tempted by those markets. So in a sense, you're forced to buy the markets which are already selling at a premium, which is Mexico, which is increasingly China and India. And I think if you stick to those markets, you're probably going to be best off. But the political risks are there. And I do think sometime during 2015 that fair or not, capital markets may lose a little bit of patience with the Indian government. We will see.
Well, that was Dominic Rossi, Global CIO-Equities at Fidelity Worldwide Investment, talk about his outlook into 2015. He's optimistic that the US markets will continue to make new highs and that India will continue to hold out among emerging markets given its improving domestic fundamentals. As we wrap up the show, we want to also give you a sneak peek into the views of Russell Napier, a financial historian and independent strategist at ERIC, who has been, a big believer of the deflation story. He spoke about it last year as well, and he firmly believes that deflation will be the real risk for global markets in 2015. Hear him out.
Absolutely. I mean, from a macro perspective, India has been in a better position for really quite some time, and the people of India owe a great debt to its central bank for that as well, because they're a central bank who, on the whole, tended to stand away from the exchange rate. The temptation is always there to manipulate an exchange rate and believe that that's a free lunch, and it isn't a free lunch. And because you've always had more flexibility in the exchange rate, that's stopped too many people borrowing dollars. We all know that some people have, but it's barred too many people from borrowing dollars, and therefore leaves the currency flexibility there so that India can move forward by letting the exchange rate come down. And now in a deflationary world, that's actually easier, because we know that one of the real reasons that India wouldn't be that keen on a weak exchange rate is because of the inflation that would come through, particularly food inflation that would come through. So deflationary world is, if you had to be somewhere, it's better to be in India. But I want to stress, as I did last year, that this is macroeconomics. It doesn't necessarily have anything to do with the stock market. There isn't any great link, long run, between the stock market and macroeconomics. Now, if the stock market was cheap at this time, this would be a wonderful time to buy Indian equities from a relative perspective, and even potentially from an absolute perspective. But the market is really very expensive.
16, 17 times, many would say that the Indian market is fairly valued. So how do you rationalize that? Because at the peak of the crisis, the trade was at about 21, 22 times. So we have some headroom from here.
There's a lot worse markets. There's a lot more overvalued markets than India, but it's in no sense it's cheap. I mean, the problem, there's a difference between what institutional investors do and private investors do. And institutional investors have got the curse of always having to do something, and therefore India doesn't look particularly expensive on that basis. However, if you're a long-run investor, India has been a lot cheaper than this, and at some stage will be cheaper again. And if you're a private individual, you should just be waiting. There's no downside for a private individual to wait until markets get cheap, and those opportunities may come only once 6 or 7 years, but they're incredibly profitable opportunities when they come.
So then, what would you buy in 2015 from, as an asset class? As I, just kind of put all your thoughts together, I get a sense that India looks okay, so one can buy India. US relative to other markets, while it might get eventually drawn in to the whole deflation risk. for now it's still kind of standing on its own, so that perhaps on a relative basis looks attractive. And then gold, you've been advocating buying gold even though the commodity hasn't done much this year as a safe haven.
Well, that's a long list there. I wouldn't recommend owning equities, full stop, if you don't have to own them. And that includes American equities. If you're saying that you can own cash and wait to take that opportunity, then you should do so. And gold, I mean, gold is not a thing you want to own in an era of deflation, which, you know, so I've not been that keen on gold for a few years because I changed my mind and thought there's going to be inflation, that's gold, deflation, that's not gold. But so
higher cash levels is what you recommend?
Absolutely higher cash levels, and you've got to be very clear where you keep those higher cash levels. I've always suggested that keeping them in Singapore was a better place to keep them. Just on the gold issue, it's really very important. In a deflationary environment with rising real interest rates and a strong dollar, the gold price should come down. But, and this is the crucial thing about gold, at some stage the next reaction that we have from policymakers will not be a monetary reaction. If monetary policy fails, what do? More of the same? You know, to do the same thing over again and expect a different result is a sign of madness. So it'll be much more aggressive government intervention in all sorts of things, maybe even potentially exchange controls. And that's when gold will start to perform, when people begin to realise that government manipulation of private wealth is the next thing onto the agenda. That's when gold goes up, but not before that. It's difficult to know when that might happen. But
so then what would you buy in 2015?
Well, just own lots of cash. I own Japanese equities, by the way, hedged back into the dollar. I think the Japanese are trapped, effectively trapped. This is a trap we've seen throughout the 20th century. The only possible buyer now of JGBs is the central bank.
Do you own Indian equities?
I don't. I haven't, because they're too expensive, you know. So I get paid to
Chinese
make these.
equities?
No, definitely not, because they're not companies.
Okay.
You know, I get paid to make macro comments, but fundamentally it's about buying things when they're cheap. And buying things that are real companies, where you get a share in the economic interest created by the company. And I would say that most Chinese companies are not there. There are clearly exceptions. I don't doubt that whatsoever. But most Chinese companies are not actually companies. Now, India's better and India's different.
So would India continue to draw more capital in emerging markets?
Yes,
just given
it absolutely
on a
will.
basis?
And obviously because of the election as well. It's clearly going to, I think, very clearly going to tend to draw more capital.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.